Happy Tuesday, everyone. Welcome back to another episode of Benzinga Live. Welcome to everyone who joined us from Benzinga's live trading. Shout out Ryan Faluna, Mitch, and Nick Brown, always the crew over there on live trading, keeping things ticking. Today on Benzinga Live, we're going to continue our conversation with Kaiju. Ryan Pannell's hanging out backstage. We're going to bring him on. We're going to be talking about AI, how to use AI to kind of maybe fix your portfolio. We're going to talk to Kaiju more about their Dip ETF, which again, if you're joining us, you haven't been with us for one of these interesting conversations with Kaiju. This is a firm, they're using AI to manage this Dip ETF. Essentially how it works is, I'll let Ryan explain it better, but in my explanation, essentially it's using AI to determine, okay, this stock has dipped a certain amount. Typically over time, through all of our knowledge, we know that this stock typically comes back after dips like this. So we're going to go ahead and invest a little bit in this stock that's down 10%. Say Disney goes down 10% in a week. Maybe the AI algorithm will be then interested in Disney and say, hey, this is a good deal. Let's go ahead and buy it. So without further ado, let's go ahead and bring my man Ryan Pannell on and see how Ryan's doing today. What is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. Ryan, welcome back to Benzinga Live. How are you doing on this Tuesday?
Thanks, Aaron. I was about to say happy Monday, but it's not Monday.
No, it is not. Even though it might feel like one, maybe a little bit for some people.
It was Monday. I don't know. It's showtime, so...
Yeah. How was your weekend? Anything fun? Anything exciting? Any sharks?
I don't think so. No sharks. No sharks this weekend. I'm in the mountains till the end of the summer on the west coast of Canada, so we don't have any sharks here.
Okay. So Ryan, let's hop right into it. I kind of, mentioned the Dip ETF and whatnot. So I'd imagine for a lot of people who are maybe curious about investing with AI, one of the things that might be top of mind is risk. A lot of people might think, okay, my money, my hard-earned money, I don't want to just turn it over to this computer that I don't know what's going on with it. So can you talk a little bit about Dip's risk containment strategy and kind of, is it different than other methods? Do you have a practical example of this risk management?
Sure. Yeah. No, and that's a really good question. We normally get asked about whether or not it's a black box system, which it's not. But I don't think I've been asked yet to substantially dive into how the risk is managed within the system. So I'll back up and just explain a black box system would be an AI system where the system is connected to tradable instruments. It's given a capital allocation and then no guidelines other than go make money. And so that system has the autonomy to do anything it wants to do. It can overweight, it can underweight, it can manage risk or not manage risk. We've seen that previously in testing. Black box systems, when given those types of instructions, tend to just gamble. Like, they're not dissimilar from humans. We call it going to Vegas. What is the most capital efficient, highest paying bet you can make? Way out of the money calls and puts and penny stocks, low float, illiquid, and it will just bet on all of these remote probabilities. And over time, it may win money, but what you see happen more often than not is that there are these drawdown periods. They're like 75% or 90%. Like, it just drives off a cliff. Like, it'll be fine. It's going to work out. And then it gets like some 300 to 1 hit. Now, obviously, nobody wants to invest in an ETF that looks like that. So we put a lot of guardrails around how we select the portfolio for Dip. So for starters, we're not trading the entire universe of stocks, right? There's no OTCBB, there's no pinks, there's no low float. These are S&P 500 components largely, and a subset of those components mostly. And then we've got some large index ETFs thrown in. So right off the bat, these are highly liquid, massive cap companies. Second thing is that we have specific diversification criteria and weighting criteria. So we don't let the system just go like all in on tech because it's hot and it likes it. It doesn't work that way. We make sure that we're diversified across industries and sectors so that when you get a tilt that can't be predicted, we're probably already present in some of that inventory. And on the diversification side, we're spread across a suitable enough array of candidates that, again, you're not piled into one or two stocks, because the AI cannot determine what's going to happen, a week from now, 2 weeks from now, a month from now. Like the rest of us, there's no crystal ball. The last thing I'd say is we probably should probably be included in that we do have a hard exit of 7 days. Like if it's still going strong after 7 days of position, we'll take it out, because again, that's probably exceeded our price target at a responsible amount of profit. And we have no idea whether the next day the CEO of that company is going to get arrested for fraud, or this is horrible negative news. So very much a take the money and run scenario. All those things together, seem to so far be proving that capital can be kept safe autonomously within the system.
Yeah, so here on, I'm looking on Benzinga Pro, you can see over the last couple months, this is going back to May, the S&P 500, what we're comparing to, is up about 8.2%. Dip is up about 12.2%. So you can see some correlation here, but in the last couple weeks, it looks like Dip is actually outperforming the SPY, where, SPY's kind of dipped. I'm saying dip. SPY's dipped, but the dip has not dipped as much. Is this kind of that risk, strategy at work here, or what's going on here, Ryan?
It's really a couple different things. One, you're looking at the trading ideology itself, right? Like there's correlation because we're using the same components. Anything that's S&P correlated, we're going to correlate to. But what we're trying to do, obviously, is not buy and hold. So we're opting in, opting out for little bumps in profit. So we do expect, a regular outperformance over time. But you're also seeing here the impact of the machine learning really kicking in this current market condition. So we don't manipulate this at all. We don't step in and say, oh, let me help you out, machine. Like, this is just self-evolving. And so as it gets better at identifying the patterns that we fed it to start with, evolving its balance and weighting of criteria that we use to make the buying and selling decisions, it's expected to do exactly this. So it's validating for us, for sure.
That's awesome. Well, Ryan, I know right now, 2023 has kind of all been about AI on Wall Street. And maybe for a lot of people, on the outside looking in might think, oh my God, this is crazy. People on Wall Street are going to be using algorithms and computers to buy and sell stocks. Well, that's been going on for a while. You talk about quant trading and different algorithms that are running. So, what makes, I guess, what Dip is doing right now that much different from what's been going on in terms of algorithmic trading? Kind of like the big differentiation there between quant trading, algorithmic trading, and then AI.
Yeah, it's really and this is a question that we do get asked a lot, the quantitative versus AI component, because the quantitative component is part of AI, but AI is sort of an evolution of that. And really it boils down to the autonomous learning part of it, the machine learning part of it. So quantitative strategy, you're looking back over 15 years of historical data, 20 years, whatever your strategy window requires, and you're putting together a system that you then get to wash, rinse, repeat, and trade over and over again. And it's probably valid up until the present day. You've tested it up until today, and it would work. So you use it going forward. And it's not unusual for quantitative strategies to have some success right in the beginning, right? Because look, you've tested it up until this point, done your homework, and so it's going to perform well. But as market conditions change, nobody's changing the quantitative strategy without some serious heavy lifting. So then you start to have off model performance. It's not working as well anymore. With an AI strategy, a completely autonomous, curated and directed AI system, it's able to learn as it goes along. It can rewrite portions of its own code so that as these market conditions change, as it finds greater efficiencies in the criteria it's using, it's like, yeah, this one has stopped being as reliable as it used to be. This one over here that we just examined for databasing purposes is actually becoming a pretty decent indicator of whether this will succeed. I'm going to weight it more heavily. So that sort of makes these strategies theoretically evergreen, whereas the quantitative systems will run for a while, and who knows, 2 weeks, 3 years, 10 years, whatever it is, not 10 years. So some period of time, and then they'll probably break. And then the vendor is either going to determine whether or not a substantial update can save the system, or they're just going to scrap it, which is why it's tough for ETFs, because you can't fold an ETF.
Yeah, that makes a lot of sense. I mean, I guess that when quant trading came out, Renaissance, Jim Simon, all this stuff. I mean, he was a forefront genius at the time. Maybe he should have been working on AI, not quant trading. He should have been
Well,
looking so far at.
yeah, well, they actually were. Rentech is one of the godfathers of machine learning and AI. I mean, they're super secretive, so you're not getting any output from that shop. But what started as a purely quantitative process, became by 2008 autonomous learning. I mean, they survived the '08 collapse because of the autonomous learning component of their systems. I mean, the famous story out of that is, first week of the collapse, they lost like 20% of their capital value. And then the second week, they lose another 20%. And the whole firm just goes nuts. And it's divided into two camps. One camp wants to shut it all off. It says, the machine doesn't know what this is. It's just like trading blindly. The other camp wants to give it more money because they figure it'll figure it out. And Jim comes in and he splits the difference. So he gives it half as much money, but he leaves it on. And by the end of the year, they posted like 126% return. So it did figure out what was going on. It did learn to predict on that.
Shit.
And then it continued. Yeah, it continued their crazy streak of this is why you have a shop that's 67% net of all fees for the past 3 decades. 297 scientists and 5 traders. Go figure.
It's interesting, I guess, once probably, they realize like how much money it could be potentially made with this technology. Like that's kind of the impetus to then push that technology further. And you
Exactly.
probably wouldn't have seen a lot of the developments of AI and quant trading if there, hadn't been like, oh wow, they're doing really well. They're making a lot of money. We could do it. So yeah, I mean that's just it just seems like that's the natural progression of technology, how it started with quant trading and then now, you're seeing it more to AI. So it's kind of cool to see that these developments happen real time.
Yeah, I mean, it leaves breadcrumbs, right? I mean, Renaissance Technologies is super secretive because it has these incredible returns and it's 100% employee owned. So there are no outside investors, at least in the Medallion Fund anymore. And so you can imagine, like, if you were making that return every year reliably as a secretary, a janitor, a quant, a trader, whatever it was, how likely would you be to talk about that outside of the walls of that firm? Probably zero, right? So almost nothing has ever leaked out of that shop. But the sort of key things that leak out are one, that their win rate is slightly better than 50%. So they have a huge asymmetrical return on risk. Two, their average trade window is 3 to 8 days. So you understand, as we have, that AI for making trading decisions works the best in the immediate to short term. It's not very good at 90 days out. And so that's the kind of thing that you can sort of take away as, okay, like if they're doing it with all of this power, we can emulate part of that. We can start researching in these areas, which is what we do.
Yeah, and it's always been fascinating to me. I mean, I think for people in finance or for people that pay attention to this stuff, they view Jim Simons as this kind of rock star figure. But for most people, you go walk around the street, 99 out of 100 people probably never heard of him, and yet he's sitting on 30 bill or whatever. And I mean, it's a fascinating story. So if anyone out there is like interested in this stuff, on the history of this stuff, I know there is a book or something about the Rentech, but I don't know, like you said, is how much information is really available about it, but it is again just a fascinating story. So Ryan, right now, as I mentioned, AI has been the story of Wall Street 2023, and a lot of it is obviously inherently soft. The conversation is about the software and about the technology, but you also have this hardware aspect, and you've seen a lot of companies benefit from this increased demand in AI, whether you're talking about NVIDIA, Taiwan Semi. Do you see any sort of bottleneck in our ability to produce the hardware necessary to keep up with the market's demand for AI? Will our technology outpace our ability to deliver on its promise in real terms?
I think it's actually the other way around. I think the limitations are going to slow us down at some point. Right now it's able to explode at like an exponential rate, and what would drop that to like a geometric rate of development would be limitation in raw materials, right? So the more chips we create, the more rare earth minerals, the materials that we need to mine. There are limited places on Earth where they're available. The conditions in those places are suspect, and it calls into ethical questions. There are ethical questions around it, and it's difficult for us to keep up with the computing needs. Right now we can, but you're starting to see that crunch, right? I mean, like if you're reading quarterly of semis. It's difficult to keep up with the demand, and the demand will keep increasing. So on the hardware side, from a rare materials, yeah, you got a bottleneck there. And then power consumption, which was the same with crypto, right? I mean, for these machines to do what they do, the power consumption is just insane. And at some point, you say, okay, there's just not enough power to go around. So where do you turn your attention to? Efficiencies in the technology itself. So this is where, sort of bleeding edge quantum comes into things with the minimization of the technology, efficiencies in power consumption, et cetera. So if we want this to continue, at some point, we can't just keep doing same old, same old. Let's just build bigger, badder, better. You got to turn your attention to, okay, how do we build this more efficient so that the bigger, badder, better can continue? And that's where I think we're at the very beginning of that. So far, no limitation, but it's walking up the driveway. It's right there.
Yeah, that makes sense. I mean, I think, right now, like if you saw during the crypto mania, I mean, there was that kind of shortage of semiconductors and whatnot. So if we run into any supply chain issues like that, while simultaneously the demand is increasing for these things, that's kind of where you can run into those sort of bottlenecks and problems. So Ryan, a few weeks ago, we talked about you diving with sharks. I got some more inside information passed off from me from a producer that you can also fly a helicopter. I mean, this seems like kind of a theme that you have some dangerous hobbies. Is there anything like is there a trend here we should be concerned about?
I can see how that conclusion might be drawn, but I was about to say, like, I'm not an adrenaline junkie, and then I started like mentally going through my hobbies and thinking,
Yeah, you're like,
it's
well,
gonna be it's gonna be difficult, but really, like, I guess if I was gonna encapsulate it all under one umbrella, it would be like just effective risk management, right? I mean, it's why I do what I do in capital markets. It's, diving with sharks is risky if you have no idea what you're doing and you just pay no attention to current conditions, right? You stick your head underwater and you got a pack of reef sharks and they're clearly in a feeding mode. Don't jump into the water. Right? I'm not going to go in there. I've done that once and I was like out in 2 seconds. You're like, okay. They take a couple of runs at you and you think, bad decision. Out you go. Helicopters, same thing. Helicopters do not like fog. They don't like bad weather. So you go out, it's low rolling fog. It's, high winds. It's whatever it is. Don't fly. And I guess that could correlate to, anything for trading, right? I mean, you look at a stock, it's the Wild West, it's low float, it's sketchy. Don't trade it. You see a market condition that you're just not sure about, which was like basically all of 2022, right? It's so volatile, so unpredictable. You're probably going to roll into strategies that you're more comfortable with, that you're gonna preserve more capital. That's going to be the ideology you follow: capital preservation rather than rah, let's make some money here. And so I think you could boil my odd choice of hobbies down into that. And just to be clear on the helicopter front, yeah, zombie apocalypse, I'm your guy. I can get us from A to B and out of a hostile situation, but I wouldn't recommend that we load up the families and go on a sightseeing tour. Like I fly helicopters passively, but not extraordinarily well.
Got it. Yeah, I've never been in a helicopter. I actually got offered to cover a story like a year ago where it was at some remote, they were opening some facility like in Canada, and you would have to go here and then take a helicopter, and I was like, I don't know, because it was kind of I don't know, there's been some news stories in the past couple years about different helicopter crashes that have deterred me. But I think about that stuff a lot, Ryan. I guess just like inherent risk versus reward. Like, for example, for me, like skydiving. I know a lot of people have gone skydiving. Looks very fun, sure. But for me personally, like, and I know it's not very risky whatsoever. You look at it like, I don't know the exact percentages, but like you're not likely to have any accidents or anything happen while you skydive. But with that said, I think about, would I personally like get enough enjoyment out of that activity to even take that minuscule risk whatsoever? And I don't think I would. Like, I think there are people out there that love skydiving so much or want to do it one time so badly that they're willing to take on that even just tiny minuscule risk to go ahead and do that. But I think for me, like, I just would it wouldn't the reward wouldn't be high enough to even take on that tiny little bit of risk.
Exactly, and that's going to be the same for everybody, right? I mean, if you boil down like risky scenarios, you're going to find some extenuating circumstances every time. This person got bitten by a shark, low visibility, high shark content. You're swimming around with seals, like their food source. They do not have fantastic vision. If there's a lot of surge, then visibility is like 2 feet. Okay, so there you go, you got bit. The news stories about the helicopter crashes, inclement weather, hydro wires, like these are not the friends of helicopters. Beautiful blue sky day, you're flying around, like people don't generally crash their helicopter. And same, I guess you could take that all the way through to the trading, right? I mean, if you're a trader, that something you're about to get into is probably sketchy, and it's that risk reward balance, the two little voices on the shoulder that you're going to be trying to find balance between, I guess.
Yeah. And that, yeah, no, it just all makes a lot of sense. I think at the end of the day, trading, like, a lot of other things, you got to weigh the risks and reward and then make your decision based on your scenario, right? Like some people might,
Absolutely.
for some traders, some portfolio managers might have a higher risk appetite and say, yeah, I'm going to buy this, penny stock or whatever the risky speculative asset is, versus someone else who might, who maybe you're investing with all your retirement money and you're close to retirement. You're not willing to take on those. You're not going to spend 50% of your portfolio on a penny stock or something if okay, I gotta use most of this money in the next couple of years. So Ryan, for the past couple weeks, we've ended our conversations with a Kaiju kicker, kind of a type of. I like to think of it as like some sort of inside information from your professional finance world to our audience, so we can get some kind of inside baseball, some inside tips from people that are doing this professionally. And I thought this week it'd be interesting to talk somewhat about indicators. I mean, if for a lot of our audience out there, people kind of day trading, you're looking at charts, you're using different indicators. What are your thoughts on like what are some good indicators to use for a retail trader?
Yeah, that's a really good one, Aaron. And I think when you were discussing tools a couple weeks ago, and we were saying that a software package is just not going to make you a more profitable or better trader. It can help you with your analysis, but it's not like you're not unprofitable because you don't have the right tools. And the same thing goes for indicators. Like there are hundreds of indicators out there. They're all basically using iterations of the same three pieces of data, right? Price, time, and quantity. And what I can for sure tell anybody who's watching is there is no red light, green light indicator. Like there's no magical combination where if you trade something on a crossover, you're going to make money. I'm going to buy this on this cross, I'm going to sell it on this cross, and I'm going to consistently make money. You may have had some positive outcomes from doing that, but I promise if you take selection of 10,000 trades applied to that, it's a money losing proposition. That said, indicators are really good to help. Their primary role, I should say, is to help you confirm something you think you see, something you think you already know. So, your number one indicator is your chart layout, right? I mean, like whether it's open, high, low, close bars or candlesticks, like that's an indicator of sorts right there. It's giving your brain a pattern that you can build up over time to recognize. And then underneath that, you're probably running, volume bars, but they're useless if you don't apply like the proper period exponential moving average, right? Because you need to know whether this volume is above or below what's normal for how this stock has been running recently. You see like strong white candle, you think there's a momentum move to the upside, but you got a green volume bar that's below the 20-day exponential moving average, front weighted probably. That's not moving with momentum. That is not actually underpinned by heavy volume. That's just working up through liquidity pocket. And so the likelihood that it's going to whipsaw and collapse is much, much higher. So that's something you can do. Add the proper period exponential moving average to your volume bars. 1, 2. You probably want to see what we call volume pressure at price. Like, I always say that if you're looking at stock price, that's the symptom. That's not the underlying disease. It's not the cause, right? It's a cough. you have a cough because what? You've got lung cancer, you got COVID, you've got a tickle in your throat, you ate spicy food. Same cough, very, very different underlying reasons. And so volume provides the underlying reasons. So to see like volume pressure at price, you're going to want to run something like time segmented volume, TSV, we call it, with an exponential moving average. I don't know which charting companies provide TSV. I know Worden does. TC2000 has TSV. If you're a momentum trader, you're probably using a period of like 18 or 20 for that. You'll want a strength of price trend indicator. RSI is usually the fan favorite. Only I do something a little differently with it. Most people run our RSI and with an EMA as well. I actually run the short term over the long term. So I'll run an RSI 15 over 75. And that shows me the current strength of the short-term price trend over the long-term price trend. And I tend to set overbought and oversold to 80-20. Some people use 70-30, but in the current market condition, a little too many touches for my liking. And again, like altogether, none of that is like this crossed, I'm going to buy it. But you have a strong up move on your chart. You have above average volume associated with that move, and it's been increasing leading up to that move. So you're seeing like quiet accumulation that happens unlit off exchange. You see that the time pressure is like substantial. It's moving upwards. It's over a moving average. These are larger block aggregated orders in compressed time periods. Okay, cool. You see that the short term is over the long term, crossing over it. So you have a swing in price sentiment for sure. All of that together matches with your analysis. You can feel more confident about making that trade, and the opposite is true. And the only thing that I would add as a caveat at the end is a warning. If you use MACD, please stop using that indicator. It's terrible. I know it's a fan favorite of retail. Oh, I got a good MACD crossover, I'm going to buy that. One, it is incredibly laggy. You're not seeing something that's happening right now. You're seeing something that happened and is now showing up in your indicators. So laggy, number one. Number two, the professional side programs algorithms to predate on that crossover because they know retail will buy with market and limit orders. What do I mean by that? So I don't know, I'll use your example. We're holding a big Disney position, and I go to the PM and say, yeah, I want that unwound today. It's no longer meeting its price target. We've met the price target. The risk envelope is too large, whatever reason. First thing that guy's going to do when he goes to his executing trader and says, we need to unload this position by EOD, is that executing trader is going to see whether or not there's a MACD crossover that's close, and will unload into that crossover if they can, because retail will take it all at the offer and it'll just bid right up and you get an extra point out of it at close. Like, don't willingly throw yourself into a piranha tank. It works on both sides. HFTs predate on it because there's this love of MACD. These institutions manipulate flow around it. So don't be part of that. You don't need it. It's not going to help you. Just leave it on the side of the road. That's my final piece of advice on indicators.
Yeah, and it was funny because I mean, when trading kind of blew up during COVID and everyone was buying and selling stocks and Robinhood and all this stuff, MACD was one of the ones that everyone was using. Everyone had MACD on their charts and was talking. And so it's interesting, I guess, that one of the most popular indicators that I saw being used among this new wave of retail traders is actually one that, as a professional trader, you're saying, hey, don't bother with that. So these are the exact types of inside baseball tips that I expect and love about the Kaiju kicker. So Ryan, before I let you go, I want to ask the audience if they have any questions for Ryan, anything about the Dip ETF, about AI. And I also will mention we will be back with another one of these segments next Tuesday, same time, 11 a.m. Eastern. If you want to continue to learn more about how Kaiju is using AI to run their Dip ETF, and just in general about, it's not just about the Dip ETF or this. We're getting all these types of insights about trading in general that you can take away with you. So we will be back next Tuesday. Ryan, any other thoughts while we wait for some questions to file in?
No, I just say, adding on to what you said about the popularity of MACD, I'm probably going to get like angry peer BBMs on my terminal once, if anybody that I know is watching this, to be like, why did you say that thing about MACD? I mean, you're not going to see people who profit off of the use of this indicator coming out and saying, don't use this indicator. I mean, you know, I say that because one, I years ago I was a retail trader, and finding out after the fact some of this stuff, it's irksome. So you want to save
Yeah.
as many people as you can from plunging down the right thing. It can seem like it works. It's almost self-supporting. You run a 8, 12, 24 MACD, and you're looking at it and you're looking at price, and you're like, man, like all of these crossovers line up. Yeah, but remember that it lags and it adjusts, right? So did it look that way on the day? No. Would you have made the same decision? Probably not. When did the crossover occur? The next morning, or during the trading day? And then you go back far enough, you're just not going to see that correlation of profit. I know it looks that way, but it really isn't. And it's not worth it at the end of the day. It's much better to like develop good pattern recognition skills, get a core set of indicators. Don't add like 20. One or more will always contradict the others, so you'll end up confused. Me, when I actually sat at desk, I probably used 5, and that was it. And I got really comfortable with my analysis and my 5 indicators for confirmation of my bias, and that worked out really well for me. Ultimately, again, it's not like you're just trading a crossover. They confirm the execution part of another strategy, like strategy that you're running. So I have this strategy goal, and when this happens, I check this to make sure what I'm seeing is correct, and then I'm going to execute on my strategy. Like, it's not like, hey, I got green, green, green across the board, I'll just buy this for no other reason. That also probably won't work over time. Just add that at the
Makes
end.
sense. Yeah, and I mean, it's right now. I feel like with the in general, just AI has become such a big part of the conversation that it's like I feel like a lot of traders now are not. I haven't heard as many people like retail traders that started trading. They were talking about all these indicators and stuff, and now everyone's talking about AI. It feels like I don't know. Maybe a lot of these traders have gotten washed out over when the markets got a little bit less friendly, I guess we should say, over the last couple of years. I do see some comments flying in from the chat. Marky wants to know: are there any sectors that the ETF focuses on?
It's actually broadly focused, so it doesn't drill down to an overly focused tech sector, for example. Like, you know, our general overview is that there are already sector ETFs. If you're interested in that, you've got Qs, you've got the X's, you've got, broad market. So what we're trying to do is give you a little bit of more refined price positivity and profit within that S&P universe. I mean, the momentum side of dip will skew while still holding its diversification. So, if tech dips across the board and tech pops, it'll push as far as we're comfortable pushing, which is about the same weight as SPY has for tech, into those areas. But no, it doesn't really focus on a specific sector.
And then I see someone else asked, what ETF do you manage? I think I can handle this one, Ryan. Dip, ticker DIP. I'll throw that in the chat as well. But Ryan, all right, I didn't realize how long we've gone. I know you're a busy guy. Now it's 11:36 a.m. Eastern, so I got to let you go. But always great having you on. Again, we'll be back next Tuesday. Everyone in the audience, we're so lucky here on Benzinga Live that we actually get to talk to Ryan, someone who not only has like inside knowledge about AI, but also investing at this kind of, crossing point that we're at right now, where, it feels like, all right, AI's here, AI's coming to Wall Street, and we're not really turning back. It's not gonna, be like, okay, yeah, we tried that. No, we're not doing AI anymore. It seems like it's here, gonna be here to stay. So we're really lucky to be able to talk to you, Ryan, and get some of this inside knowledge. And I truly appreciate your time and hopping on the show. So with that, I'll let you go. I'll let you get back on with your busy Tuesday, and looking forward to next week.
Thanks a ton, Aaron. I'll see you guys next Tuesday.
All right, guys, that was Ryan Pannell from Kaiju. Going to drop that link in the chat. Again, the ticker is DIP, ticker DIP. Yeah, like I said, like AI is now going to be part of finance, part of Wall Street. I can pretty confidently say, at least for the rest of my life, maybe when I'm older, there's something, we saw quant trading, now we're in AI, maybe there'll be something else after AI, but for now, I mean, this seems like the biggest thing. And so to be able to get, again, some of this inside knowledge and Ryan's insights is very valuable. All right, 11:37 a.m. Eastern. I see my man Nick Brown hanging out backstage, looking snazzy as always. So without further ado, let's bring my man Nick on, see what news stories he's been watching. I had to keep you on your toes there, Nick. Give you both intros. Yes. Nick, what's up? Happy Tuesday. How you doing?
Happy Tuesday, AB. How are you? I'm doing well. Just very busy 13F since last night.
Yeah, I mean Michael Burry, the big one. Any other notable headlines? Anything you take away from what want to talk about there?
Yeah, well, there was some Viking Global, Third Point, trying to go through and seeing if there's any stocks that correlate each other. And so I've been doing this morning through late last night. I started this late last night. But Tiger Global, they're boosting their stake in NVIDIA, which also comes on the heels as Third Point is adding NVIDIA, along with Tiger Global reducing Amazon and Google, where Third Point is buying Amazon and reducing Google, along with Viking Global reducing Amazon. So I'm just trying to pair up and correlate the similarities and differences of kind of the different sectors and different stocks that each 13F, like Elliott and Third Point and Tiger, are trying to do here.
Yeah, and I mean, when we get these 13Fs, it's interesting because people write about them. People, whatever, make a big deal about Michael Burry, but we get them after the fact. Like this is, these were the end of Q2, so we're talking about June holdings as of June 30th. So yeah, these puts and stuff that Burry had, I mean, he could be out of them by now. He could be, I don't know. So it's to me, like, I always like, they're interesting, but I feel like sometimes people take too much. It's like taking with a grain of salt. They're old. They're we're 6 weeks away now from that point. And the other thing too is the way it's covered. People are like, oh my God, Burry has $1.5 billion of puts. Like, not really. That's not how much his investment was. That's the notional value of them. That's like if the options get exercised, it'd be worth that much. So it's not like Burry put out a $1.5 billion bet. I don't think, at least. I don't really know. I haven't looked too much into it, to be honest.
Yeah, I was going to say, so continuing with the Michael Burry thing here, he dissolved his stake in Alibaba, JD.com, Wells Fargo, PacWest, but he bought put options as of June 30th against $739 million worth of Invesco QQQ. And he also bought put options as of June 30th against $886 million worth of the SPD, or S&P 500 ETF. Remember, he's a day trader, so I'm guessing he either is out of them or he is added to them. So I don't really think it's anything to make big of.
Yeah. Well, what about other big headlines on the street today, Nick? Anything exciting?
Amazon, we found out that Amazon's device chief, David Limp, he is leaving the company before the year end. That's according to the Wall Street Journal and a spokesman confirming to the Journal. To give you some background from him, he oversees Amazon's Alexa and a portfolio of other services and gadgets that have in some cases proven popular, but overall have struggled to make money. He is going to conclude a tenure of more than 13 years at Amazon. So he's had a good run. It's just shakeup, but we've seen multiple executives leave under the new CEO.
Got it. I see someone in the chat talking about IonQ. This is a What is this, a supercomputer stock? I mean, this thing's been on a run, up 11% today. So whoever dropped INQ in the chat, Hot Pepper, let me know, are you long this stock? Why'd you get in this stock? What's your price target? I've been hearing more and more people talk about this stock, so it's kind of like on my radar now, but I still don't know a lot about it, so I want to learn more about it to decide if this is going to be one that I delve into or not.
I was going to say, AB, regarding this stock, it actually got some upgrades yesterday. Price target increases. Goldman Sachs goes from 9 to 14. Benchmark 17 to 20. Morgan Stanley 7 to 16. They're basically, and we wrote about it yesterday on .com, on Benzinga.com, basically saying IonQ's quantum adoption accelerates. Analysts say anticipated hardware sales and broader industry interest evident. And that's basically just showing here that more coverage is happening, targets upgrading, and more people like IonQ.
Interesting. Let's go. Just clipping through kind of the overall indices right now. Qs are trading down. SPY, everything kind of seems a little bit in the red today. I know, we talked a lot about gas prices yesterday. If we go to the USO, looks like oil prices are actually getting a little crushed today, down 2%. This is off of growth concerns in China, which, I mean, like, I don't know, for anyone who has been paying attention to the news cycle or who tracks energy prices or oil, like anytime there's a substantial rally like this in oil, it feels like there's always some sort of dip. And I don't know, like this could just be me, but it always feels like that's the headline. It's always China concern. Because, okay, if you think about it, it makes sense. China's economy is so massive that any slight downturn or any slight decrease in growth is a big problem for the overall energy global market. But it's almost just like chalk it. It's almost just like get ready for it. If you're long oil, like get ready for there to be a headline about some sort of China concerns, and then oil to dip, and then I'm sure tomorrow it'll be back up. Like I don't know, but either way, this is just something to watch. I think for if you're looking at, if you're looking at, I think following gas prices, like we mentioned yesterday, is something that would be smart to do right now because it just might give us like a nice little inkling if inflation is going to end up coming down or pick back up, especially that diesel price that I mentioned yesterday, because the more and more you see diesel go up, the more likely those costs are to be passed down to the consumer, which means we'll be paying more for goods, which means inflation will go up, which means the Fed will probably have to raise again, which means stocks will probably go down. So, all this, like literally the trickle down effect of diesel prices going up to your stocks and your portfolio going down is a real thing. Like, and it's not that simple, of course. There are all these different intricacies, things going on, other things. But that still seems to be like the biggest focus right now in terms of macro, headwinds and tailwinds. Is this inflation, problem really going to be stamped out completely, or are we going to be dealing with a more recent uptick in inflation that will cause, again, the Fed to potentially continue to raise as opposed to being able to pause and then be data dependent and then eventually maybe even cut?
Well, I was going to say regarding the China front, they reported data last night. They missed on all expectations. Retail sales only rose by 2.5%.
Who did?
What'd you say?
Who reported, you said?
China. They reported data last week. Retail sales missed. They came in at 2.5%, below expectations of 4.5%. Industrial production only rose 3.7% over year, below expectations of 4.4%. Fixed asset investment rose by 3.4%, below expectations of 3.4 or 3.8%. And they say that they're going to stop releasing youth unemployment numbers just because of the big data miss. But I reported last week on this show, and we were talking about it last week, that China is telling, and this was reported by the FT, China is telling economists and people who are in China to only report the good numbers. They don't want to hear about the bad stuff, that it's deterring people away from China. And I think we touched on this too yesterday. You have to be open-minded and you have to kind of report both sides, just because China is having some growth concerns. And it is very real, just because this data last night for us today missed. But I mean, from the National Bureau of Statistics, they say, quote, "We must intensify the role of macro policies in regulating the economy and make solid efforts to expand domestic demand, shore up confidence, and prevent risks." I mean, I don't know how much worse the static can get if this is just the start.
Yeah, and I mean, I think with these things, it's like you look at China and it's okay. There may be some concerns there right now. If the numbers get worse, yes, like that's gonna be a big problem. And I think, it's one thing, to be looking at kind of these Chinese names, like you look at Baba today, down trading down a little bit, but it's really everything. I mean, if there are big China growth concerns and China enters a deep recession or whatever, like it's not gonna just be these Chinese names impact. It will likely be the overall market, because whether you're talking about Apple, Tesla, whoever, like all these major U.S. companies, a lot of them are doing a lot of business in China too. Like it's the biggest, if not one of, if not the biggest market in the world. So, definitely something to keep an eye on.
Yeah, to even note, China Central Bank PBOC, they unexpectedly cut rates too yesterday or late last night. This just goes to show China's economy isn't coming back better than expected, or I should say faster than expected, as it was supposed to. And that's weighing concerns broadly across the US, across Europe. I mean, here today, Wells Fargo and even Goldman Sachs, they both boosted Q3 GDP. But you have to keep in mind, AB, Atlanta Fed GDP now, I believe, is running at like 4.1 for Q3. I mean, it's just taken off. It just goes to show the U.S. economy is very resilient. That, yeah, I don't know, maybe a recession is not happening. I'm reiterating that I don't think a recession is coming. It just goes to show that people are still spending. I mean, even our retail sales data today came in hotter than expected. Retail sales, I mean, people are still spending. People are still going out. People are still shopping for new home items, new jewelry, new houses, new cars. Spending is still happening here in the U.S.
Yeah, and I mean, we'll start to see. I think, if but my thing is that, I think you'll start maybe like toward the end of summer, you might see some sort of slowdown in spending. But like, I don't necessarily think, like obviously that would be construed as a bad thing, but I think like you just have to realize that these types of cycles are natural, right? That people will be spending a lot of money, and then people might cut back on spending a little bit. Credit card debt might increase. People might start paying their credit card debts off, and the cycles just kind of continue to repeat. So if there is some sort of drawback in spending, which then correlates to a drawdown in the market, like I think we just live in such a fast-paced time now that you'll start seeing people, make these crazy calls. The market's going to crash, all this stuff. And like, I just don't like, just because there might be some headwinds on the horizon or a healthy pullback, like I don't necessarily think that means we all have to start screaming Chicken Little and the sky's falling down. So I would just, tell people like, for us, like everyday investors, people like myself, for example, like I just add to my 401k every 2 weeks when I get paid. Part of my paycheck goes to the 401k, which is then invested into like the S&P 500 and some other broad-based ETFs. I'm not going to stop that. Like, even if I think the market's going to be going down for a month or two, I'm not going to stop my investments, because I know, look, like it's not going to be the end of the world. Like if we do get, again, a drawdown in the market that a lot of people are calling for right now, it's not going to be the end of the world. I mean, the S&P 500 is up like, what, year to date still? I mean, it's like already up more year to date than the average annualized return. So a healthy pullback would kind of make sense here, right?
Yeah, and I've been reiterating this on live trading as well, with Mitch and Ryan, and even with you too, that a pullback is necessary for a market. You cannot have a stock, and I'm going to point out individual names here just because I think it's worthy. Nvidia, if you could throw up a chart of Nvidia, 400, it's up significantly year to date, and yes, it's coming back. But you cannot have individual stocks or even the S&P 500 or the major averages go up 16, 20, 30, 40% in just 2 to 3 months and say, oh, okay, this is a market. We got to continue to go higher. You eventually have to have a pullback. That's what a market is made for. It's a healthy pullback. It's nothing to be scared of. It's nothing to make of, hey, if we drop 5, 10, 15%, what do you make of it? The market is up relatively well than most people were anticipating. And that's why many firms are rushing and are throwing the towel and they're upgrading their S&P target because they don't want to be wrong. Jeffries today, they go to 4,500 on the S&P, and they were at 40.50. That's throwing the towel in right there, that they have to raise for the S&P to go up. A pullback is what makes the market.
Yeah. And again, like, in this fast-paced news cycle, I think any sort of pullback people might, start freaking out about and all this stuff. But, I think, again, like, just have for reference, I mean, if you would have bought the S&P 500 at its all-time highs, January 2022, like, you were a buyer up here after the market had already, gone on this crazy run, not only from, the COVID lows, but really, I mean, from like the 2009 lows, the S&P 500 was basically just on a 15-year bull run until the COVID market crash. And then it went on an even crazier bull run and we got new all-time highs. And so if you were a buyer up here, like, there were people buying up here. It wasn't just sellers up here at 480. There were more sellers than buyers, of course. That's why the market went down. But there were people buying the S&P 500 up here at these all-time highs. If you did that and you just sat on your investment, right now you're down about like 5%. At one point, you were probably down about 30% right here. And like, it just, you probably were like, oh my God, that was the dumbest purchase ever. But if you just hold on, then you're only down about 5%. And maybe with your dividends too, maybe a little bit less than that. So, I think just like, you got to keep in mind how cyclical these things are. I think, and my biggest thing right now, Nick, and for the reason why I think I'm still, long-term bullish and I haven't really wavered off that position is because in the event that there are some major headwinds that pop up, right? The economy does slow down, et cetera. Like, what's going to happen on the back end of that is that then the Fed's going to be able to cut. And like, so there's always, and we talked about this yesterday, like if you want to look it through rosy colored optimistic glasses, which maybe I am, is that it doesn't matter if there are some of these, like, maybe an uptick in unemployment, whatever. All these things that we would construe to be negative are actually things that the Fed might be watching out for as a sign that they can start cutting, which again, I would then construe as bullish. So, I think there are a lot of different things going on. But, it will just, it depends on your outlook. I think, if you wanted to tell me, hey, you're going medium term short and then you're going to be long, I'd say, yeah, sure. Like, makes sense. Go ahead. If you wanted to tell me you were bullish in the short term, like, and you gave me some reasons, sure. So I think this market is kind of it's like you see what you want to see out of it. It's kind of one of those, what are they called? Roark tests that they do at the that like therapists do, you know what I'm talking about, Nick?
Yeah, but to your point here, I don't think putting out analyst notes like Goldman Sachs is already trying to pencil in when the first rate cut. That's really not going to help this market. I think that's just going to worry more people saying, hey, the Fed's going to start cutting rates. We got to watch this. We got to watch this press conference. We got to watch this talk. And we still have Fed heads talking today. You got Cash Carey on the wires making comments right now saying that that they can allow inflation to ease 2% gradually over time. Cash Carey is a voting member, believe it or not. And he goes on to say that they're not ready to say when they're done raising rates. Cutting rates would be a long, long time away. We have Jackson Hole next week, and I expect Powell to make comments alluding to what's going to happen in September, what's going to happen in November, and when cutting rates is going to happen, just because it's already being penciled in by Goldman and other firms. But also, now you have to worry about strikes, AB. If you could throw up a chart of Ford, GM, and Stellantis, this just hitting the wires. The UAW is saying they are announcing preparations for a strike authorization votes to be held next week by 150,000 UAW members at Ford, General Motors, and Stellantis.
Woo!
And they say auto workers to vote on whether to authorize strike in preparation for September 14th deadline for contract negotiations with the big three automakers. If they go on strike, I don't think the Fed will be worrying about cutting rates anytime soon.
Why do you say that?
Just with now people are talking about supply and demand, that if they go on strike, we're going to have some supply and demand issues. There's a lot of talk regarding this. So we're going to have to watch this strike. We're going to have to watch, UPS was able to avoid a strike, and the workers now are going to
Well,
be able to.
typically they do. There's the threat of a strike, and then typically the companies and unions are able to come to some sort of conclusion. I see a lot of different, and I know, I guess, like, unions in themselves have, people, depending on your politics, some people like them, some people don't, etc. But the bottom line, unless you're like the top 1%, you're the owner of a company, like these are workers that are banding together for better working conditions, for higher pay. Like, it doesn't matter politically what side of the aisle you're on. If you're someone who, wants workers to be able to have a better life in America. You hear all the time stories about people who work full-time jobs and still aren't able to afford rent, or an accident pops up and then they're bankrupt all of a sudden. Like, this should be things that you are rooting for, things you are happy about, that people are then able to. Because like bottom line, like, if you look at, and I know people are making a lot of jokes, like UPS driver, like, oh, how much a UPS driver is going to make now, whatever. People realize that UPS drivers had to threaten to strike just to get air conditioning in their trucks in 2023. Think about that. Think about how hot this summer is, and you're in that big black truck, and you're wearing like your uniform and stuff. I had no clue these things didn't have AC.
I didn't know either. No.
Yeah. So again, like, it really irks me when I see people be like, oh, unions threatening a strike, whatever. And it's like, okay, like, you can thank literally every single benefit that we have from working. Weekends are because of unions. A mandated 40-hour work week, like overtime pay. If you have ever gotten overtime pay because you worked more than 40 hours in the week, you can thank unions for that. Healthcare benefits, you can thank to unions. Like, every single thing that has given workers more power, more benefits than from when, like, they had kids working in the factories, you can all boil back down from unions. Because throughout our history in the United States, like, workers will continue to get exploited more and more until they do band together and then threaten that sort of strike, unionization. Because otherwise, what's going to happen is the workers working in the plants for Ford or GM or whoever are going to continue to get screwed over, and the companies themselves are going to continue to raise their bottom lines and continue to kind of have this exploitation on their labor. So again, I don't understand, I guess, how it's gotten so politicized, because to me it's like as simple as, hey, if you're someone who works for a paycheck, unless you're running your company, signing your own paycheck, then like you should be a big freaking fan of these unions that are fighting for better working conditions all across the country.
I can even argue that for teachers. People don't realize how hard teachers work and how minimal pay they get for all the crap that they have to put up to. Especially, I alluded to this last hour. I watched a TikTok video, AB, and there's this one older teacher, and there's many older teachers and teachers in general, that they don't have enough to take home because they spend a lot of it, most of their paycheck, on their students, buying the essential needs that they need: notebooks, pencils, erasers, books, notebooks, because the school district isn't supplying them, and at home they can't afford them. And it's just so sad to see that teachers cannot live the way they want to live, is because they spend so much on their own children in class. And it just goes to show that teachers do really care. Some teachers care about their children, their students in class, that they want to make sure they succeed before they succeed at home.
I know. That's one of the most insane things to me. I have a lot of friends now who have, gotten into teaching and whatnot. And I see all the time, especially around this time of the year, Nick, that people are posting GoFundMes for like classroom supplies. Like, hey, I'm starting up, my 5th grade class. Like, we're trying to get markers for the whiteboard. And it's like, what are we doing? What are we doing as a country that the teachers themselves have to be raising money on GoFundMe for classroom supplies? It makes no sense. That should be... That should ever, like, what? Like, that makes zero sense to me that we allow this to happen as the richest country in the history of the world. Like, you go over to other countries in Europe or whatever, if you told the teachers in Sweden that, like, hey, yeah, teachers in America are raising money from their friends to be able to buy classroom supplies, they'd probably laugh in their face. So, that is like an issue that I think, you're seeing, like, it's again, I don't understand it. So I know.
AB, I was going to say, as we're talking right now, there's a new update from Atlanta Fed. This thing continues to go higher. I'm not making this up. Q3 GDP for Atlanta Fed is now reading 5%.
What the hell?
5%. That's from 4.1 just last week.
That's like that shows you the it's kind of like the Warren Buffett, Charlie Munger mantra of like, just don't bet against the U.S. economy, right? You can go bet on the, you can bet on the New York Yankees. You can bet on the New York, on the L.A. Dodgers. Hell, you could even bet on the Philadelphia Phillies, but do not bet against the U.S. economy. That's what Charlie Munger says. So, all right, Nick, it is a little past noon, so it's time for us to wrap up. But we'll continue to watch this, GDP raise, all these things going on.
I was going to say really quickly, we just got some Google news. Google unveiled search generative experience earlier in 2023, and Google to expand use of AI tool for search across the web. That's the latest headline that just crossed literally a minute ago.
Yeah. All right, Nick. Well, again, thanks as always for hopping on Benzinga Live. We'll get you back on again on Thursday, and chat soon.
Yep. Thanks, AB. Have a good day.
Thank you. All right, guys, that was Nick Brown, News by Nick on Twitter. If you want to get more from Nick, thanks everyone who tuned in today. Please smash the like, subscribe to the channel if you have not already. Give us a follow on Twitter, Instagram, TikTok, you name it. Peace and love, y'all. We'll be back.